Hey there, and welcome back to my channel where we discuss all things commercial real estate. Today, we're going to dive into a very important concept, the capitalization rate, or cap rate for short. Specifically, what is it and how to use it, along with the pros and cons of using a cap rate to evaluate an investment. So, what is a cap rate? Simply put, it is the ratio between the purchase price and the first year income, assuming the property is not leveraged. The formula for cap rate is cap rate equals net operating income divided by the property value. Now, the net operating income is simply all your income minus all your expenses equals your NOI. The property value is what the property sold for, or the asking price on a listing, or what a buyer is valuing the property at. So there are a few different ways to calculate and use a cap rate, so let me explain those in more detail. Let's say you have a listing for a property and you're trying to figure out the cap rate. You would take the NOI and divide it by the purchase price of the property. So, for an example, we have a property with a NOI of $100,000 and the property is listed for $1 million. You would take the 100,000 and divide it by the million to calculate a cap rate of 10%. Next, you might have a property that you're trying to evaluate, and you know the cap rate in that market for that property type is around 6.5%. You also know the NOI of the property is $500,000. So for this property, you would take the NOI of 500,000 and divide it by the cap rate of 6.5% to get the purchase price of about $7,682,000. The last way you need to know how to use a cap rate is if you have the cap rate and the purchase price, but you're trying to understand how the property is operating financially. So in this case, your cap rate is 7% and you have a purchase price of $4 million. You would just simply multiply your cap rate of 7% by your purchase price of $4 million to find your year one NOI of $280,000. Now, let's talk about some of the pros and cons of using cap rates to evaluate real estate investments. One of the biggest advantages of using a cap rate is that it simply is a quick and easy way to compare different opportunities. So if you have two properties with similar incomes, the property with the higher cap rate would generally be better investment, everything else being equal. However, there are some important cons to consider when using a cap rate. For example, cap rates do not take into account the impacts of leverage or borrowing money to invest in real estate. If you're using leverage, your return on investment will be different than the cap rate. The cap rate also does not take into consideration any tax implications the investor would need to account for. The last factor to consider is that cap rates are calculated based on the current year income. So if you're buying a property with a lower current income and you're looking at ways to raise that income, the cap rate may not accurately reflect the investment's true potential. It's also important to know that cap rates can change depending on who the tenant is or where it's located, or the age of the property, the condition. There's a lot of factors that go into a specific cap rate for a specific market and a specific property. So it's important to keep that in mind and to be sure to know what other cap rates and other properties are going for in that immediate area. To sum it up, cap rates are an important tool for quickly evaluating real estate investments, but they should be used in conjunction with some other analysis tools that we're going to talk about on this channel. So remember to always do your due diligence and consult with a commercial real estate advisor before making any investment decisions. So if you have any questions or comments about cap rates or real estate investing, please leave them below. And if you found this video helpful, don't forget to like and subscribe for more content like this. Thanks for watching.